Hey, what's up, everybody? It's Jonathan Bunk. I'm here with my man Jordan Lawrence, and it's another episode of
Hugh Knows.
So we first want to start off like we always do. This is not the opinions of our parent company, Network Funding. We're Bunk & Baker Mortgage Group. We're a local retailer for Network Funding here in Houston, and this show is all about what's going on in the market, the economy, our thoughts, so they don't reflect our parent company's thoughts. But we have another great episode for you today. So Hugh, let's start off with the agenda, brother.
Absolutely. So we're going to flash up the agenda on the screen right now. So the first thing that we're going to cover is the Fed's dilemma. So the Fed has been acting to raise interest rates to curb inflation, and they've been really running into a tight labor market. So we're going to jump into that. Next, we're going to look at the CPI numbers. Today, we're recording on May 10th. The CPI came out this morning, so we're going to talk about the CPI numbers, and then what the Fed is expecting to do for the rest of the year, and what the market is expecting the Fed to do. And then we're going to jump into loan level price adjustments very quickly, and then we're going to talk about the cost of waiting with Jordan, and then finally end on some Houston area analysis. So let's jump into it.
Let's go, guys.
So the Fed's dilemma. On this first slide, what I'm showing a couple different things. So first, focusing on the chart on the left, what I'm showing is two different data series, and the chart has two different y-axes. So the first data series I want to focus on is that dark blue line, and that's showing a labor force participation rate. And so what that is showing is basically all the people that are actively looking for jobs versus the total civilian workforce population, or the total civilian people that would be of working age. And so what you can see there is that we saw a drop after COVID, and you can see there's a significant drop of COVID in early 2020, and we really haven't recovered back to pre-2020 or pre-COVID levels. And what I'm also showing is the unemployment rate. And so that's plotted against the left-hand axis. And what we can see there is the unemployment rate is really low. In fact, it's actually at a 53-year low. And so what this is showing is basically we've lost some people in the job market. People have dropped out of the job market. And so that's kept the job market tight, and that's kept unemployment very low. And so the Fed is having to deal with that because the cost of employment is a major part of inflation. And so the Fed is really combating this very tight labor market. And one of the things that's, a result of the tight labor market is that employment costs are up. And so we can see that on the chart on the right in the green bars. And what this is showing is an employment cost index, the quarter over quarter change. And what this is showing is basically the salaries and the benefits that employers are paying on average. And we can see that in early 2021 and in 2022, we were seeing some pretty large increases on a quarter over quarter basis. And so that's what the Fed is dealing with. They're trying to curb inflation by slowing down the labor market and raising interest rates in doing so. And this is the milieu that we're in. So that is it for that section.
So Hugh, quick question for you. Is the higher cost of labor, is that putting pressure on inflation? Is that keeping inflation elevated? Employers are having to pay more for employees. Is that part of the problem here?
Yeah, so what you pay an employee for their job, that's going to be a major cost of what it is to produce whatever product or service you have. So absolutely,
always gets passed on to the end consumer.
Exactly. So what you're paying for somebody to work for you is a big component of the price of the product or service, and that's what a big component of what's driving inflation right now.
Yeah, for y'all that are watching, a lot of our audience is home buyers and realtors. Like, we all know inflation is a big issue, and the Fed keeps raising rates, and we're like, when is the Fed going to pause? When is the Fed going to stop and say it's been enough? Well, this story of unemployment, labor participation, even employment cost index is saying that there's a case here, looking at this data, that they might keep hiking.
Yeah.
So this is, someone says, make a case for why the Fed should keep hiking. This is the case.
This would be the case.
Exactly.
Okay, but
it's not the case.
That's not the case. That is a case, and there's some other factors that they have to consider, and we'll get into that in the next segment. Yeah. So in this next segment, we're going to be talking about inflation and what the Fed is expecting to do versus what the market is expecting the Fed to do.
It's like two people over here. You got the Fed and you got the market.
You're
kind of like in the box.
Yeah, and they don't necessarily agree, and so we're going to see that in the next couple of slides. But on this next slide, what we're showing is the consumer price index. And the data came out this morning. Like I said, it's May 10th today that we're shooting, and it came out this morning. And what it showed is that inflation in April on a year-over-year basis was 4.9%.
Woo!
And that might sound not
Hands
great,
up.
but it's actually
That's
lower
awesome.
than the March number. So you can
First
see
time we
that.
dropped below 5 in a while.
Yeah,
So,
yeah. So
It was almost what, 6.5%, 7%.
yeah,
Nine,
well, it was
8, 9,
8%,
yeah.
9% in last year. So you can actually see on the chart.
That's
and
a long way down.
I know. We've come a long way, and there's been a lot of improvement over that. So that's something to be excited about. And on the chart I'm showing in the blue line, that's the overall CPI number, and you can see that that's been steadily decreasing. Now, less positive is that orange line, that core CPI number, which excludes food and energy prices. And that has not come down as quickly as we would like it to come down. But there is some good news in there, is because the core CPI excludes food and energy, but it includes shelter costs. And what we're going to see in the next couple of slides is that we're expecting shelter costs to come down because we're expecting rents to fall.
Yeah, when we say shelter, Hugh, just a quick overview. What all is included in shelter when they're looking at shelter cost? Obviously,
Right.
we have home ownership, we got rent. Is there anything else that's included in that?
No, it's basically what people are paying for where they're living. So,
Okay.
You're either going to be renting or you're going to be owning. And so if, a large portion of the population is renting, and if costs for them are falling, that's going to have a positive impact on the inflation, i.e. inflation would be lower.
Yeah, but overall, I feel great about where the numbers are.
Yeah, and
inflation's coming down. The medicine the Fed is giving the economy higher rates is actually working.
Absolutely, and I think that we've made a lot of progress. There's still progress to go, but I think that we're definitely headed in the right direction.
Yeah.
So
When things flipped, real quick, Hugh, when things flipped on the core and the CPI, when they kind of traded places there, is that due to shelter staying high? Is that the main driver of that core number?
yes,
Okay.
and food and energy prices coming down
Okay.
a
Faster
lot quicker
Okay.
than shelter. So yeah,
Perfect.
that's a good point. Food and energy prices have fallen a lot quicker than shelter. And the way it's calculated, shelter has a little bit of a lag. So we are expecting it to fall over the next couple of months, at least that component of CPI, and we'll see that on this next slide. So Redfin actually published an article, which I thought was really interesting, back at the end of March, which had some data that showed that on a national basis, we're seeing median rental prices fall. And so you can see on the chart on display that on the left, this is data from Redfin that's showing that since about middle of last year, we've seen a pretty marked decline in average or median rent prices, which is great again for the inflation picture.
I look at this slide and I'm like, man, if you're a landlord and you're a real estate investor, you're doing pretty good with the rent you're getting, right?
Right. Yeah. I mean, definitely some elevated rents now. Of course, it's still higher than it was in 20 before COVID came about, but a lot lower than the peak that we saw last year when prices.
But one of the things you say, Hugh, all the time is like during inflationary environments, having real assets is a good hedge against inflation, like owning real estate, right?
Sure.
I might own a primary residence, but why not buy a rental property and hedge inflation? And like this kind of shows you if you own a rental property, like not only is the house likely appreciating, also the rents are going up as well.
Yeah.
It's interesting too. I just noticed that it's not step for step, but this chart kind of follows the way rates have gone over the last couple of years, right?
Right.
We saw them really. We saw the hiking cycle begin, and rents kind of followed that, and it looks like they kind of peaked when we saw rates peak, maybe late fall. So hopefully, as we see not only shelter for rent decline, but we see the interest rates come down as well. Overall home ownership come down. Maybe we'll see kind of a double whammy here with shelter
cost
really
for
coming down.
home ownership. Yeah, absolutely. I mean, certainly 7.5% is worse than 6.5%, and we were in that 7% range.
A lot of people can't qualify for a mortgage that's 7.5%, and have to rent. So
exactly.
Kind of like Jordan said,
Yeah.
that's why rents pushed up.
Yeah.
Now that rates are coming down, maybe it's affordable for people to buy, and so now rents are going to start coming down.
Yep. Absolutely. And so on this next slide, we're going to jump into what the Fed is expecting to do versus what the market is expecting the Fed to do. The market was expecting the Fed to increase 25 bips, and that's what the Fed ended up doing. And so what the question is what is the Fed going to do over the next year, over the next 24 months? And when the Fed meets, they often will put out their expectation for their policy moves, i.e. what they're going to do with interest rates over the next 2 years. And what we're showing on display on the chart right now is the red line is showing what the Fed says it's going to do over the next couple of years. And what the blue line is showing is what the market, based on interest rate futures, is expecting the Fed to do. And you can see that the market is basically expecting the Fed to cut. And on the chart, I'm showing the circles on the blue line is when the Fed is supposed to meet over the next couple of years. And so what the market is anticipating is that the Fed, unlike what the Fed is saying, that the Fed will actually cut.
Yeah, essentially the market's calling the bluff on the Fed. Like they're saying we're going to be hawkish and we're not going to do any rate cuts until 2024. And the market's like calling your bluff on that.
Yeah, it's almost the Fed wants to cut any. They want to curb any enthusiasm, right? They want to make it maybe seem a little bit more doom and gloom than it needs to be because they don't. Their main battle, right, is inflation. So they want to slow people down, slow the economic activity down a little bit, have a soft landing, right? So it seems like they're trying to curb a little enthusiasm here, but the market has other ideas.
And the audience might be asking, well, which one actually influences mortgage rates, Hugh?
I mean, they did both influence mortgage rates, but the market is, that's what actually people is reflecting.
The market is where people trade. The
Mm-hmm.
market is where people put money to work, buy bonds, MBSs, T-bills. The market's where money's moving around.
Absolutely.
And so if the market's moving, in a direction where, this is projected, then rates could get better based on where the market's at. But then the Fed could catch the market off guard.
Of course, and then we would have to have a correction.
Exactly.
And then on this this last slide, just to round out this segment, what I'm showing is the market's expectations of what the Fed is going to do at different points in time. And so basically the blue line is earlier this week, and then the orange line is a week ago, and then the red line is a month ago. And the point here is that the market expectations haven't moved too much over the last month. They've been pretty consistent in their assessment that actually we are going to see rate cuts later this year.
Yeah, so the big story you've all seen in the news is all the bank failures. And so the Fed is saying, what Jerome Powell say, our banking system is what?
Yeah, resilient and secure.
Resilient and secure.
Sound, yes.
Literally the next day you hear about PacWest going down 60 or 70% in stock value, maybe a potential bank run about to happen there. And so we have more bank failures happening. We have more just issues happening in the banking system. And so the market's like, there's no way the Fed can hold at 5 to 5.25 federal funds rate through 2023 because we're going to see more and more banks. And the market's thinking the Fed's got to come down.
Yeah.
And so that consensus started at SVB, which was, 30, 45 days ago was the first one?
Yeah, so it was in March when that happened. So yeah, we're right at maybe almost 60 days ago at this point.
Yeah. So the last 60 days, the market is like they have to cut at some point.
Yeah, I think that if you look right before SVB, the market was much closer to what the Fed was saying, and now it's lower. And like I'm showing on this chart, it's consistently lower. It has been over the last month than what the Fed is saying. So,
Yeah.
Yep. All right, so that ends it for that segment, and now we'll jump into the next one.
Boo!
Loan level price adjustments. So
I know, guys, y'all probably like, we don't want to hear about this. This is so crazy, but we've gotten so many phone calls and emails and texts, and we've tried to explain it. I mean, it's irrational, it's illogical, and I was telling somebody the other day, it's like when things are illogical and irrational, it's kind of hard to explain them in a rational way.
Of course. But
So-
we are going to give it our best shot. So on display here, we're going to try to line out exactly what the changes are. Okay, so what we're showing here is the change in discount points with the new loan level price adjustments versus the old. And we're breaking that down by FICO score and loan to value, or how much you're putting for a down payment.
Yep.
So what you can see is that there's different colors, and the different colors represent the change for the benefit or for the worse for the people in those categories. So if it's red, that means your discount points increased with the new LLPAs, and if it's green and the numbers are negative, that means your discount points decreased, which is a good thing for those people. So, and then we're breaking that down again, like I said, by FICO score and by how much you're putting in down payment. And you can see that the people or the borrowers that are in the red category, in the red zone, they're getting about a 75 basis point increase for discount points. and their down payment's going to be in the 15% to 20% range, and their FICO score is going to be 720 to 760,
which is the average borrower.
Which
right?
is the average borrower.
Yeah.
So, and then the people that are getting the most benefit, you can see on the bottom right, and they're going to be those that have a FICO score below 660.
Yeah, you could say that people have bad credit and no money.
And are putting
the biggest
a
benefit.
low down payment, and
Yeah.
they're getting the most benefit from
Yeah.
these changes. And so that's really the encapsulation. We don't think that this is going to be a major impact. We don't think that all of a sudden more people are going to qualify or more people are not going to qualify. At the margins, maybe. We don't think it's a huge change, but it does sort of add some extra costs for some people that did not have those extra costs, and reduces costs for people that would have had those extra costs. So that's basically the long and short of it.
Yeah, and the way I've been explaining it to people is loan level price adjustments have always existed. You know, if you have a 620 FICO versus an 800 FICO, you're going to get a better credit score. And they've always kind of followed a rational thought process. And so you have like the really high risk borrowers here, you have the very low risk borrowers over here. Well, this side's always had the max amount of fees to get a loan. This side's always had the lowest amount of fees to get a loan. And what the FHFA has actually done is brought these people closer together to make things more fair, essentially. But what the news is telling you is like these people over here with less risk and more risk, almost like they crossed or something. And that's not true. It's just the people who had no fees that are less risky, and the people who've had the max fees are really risky. They just brought them closer together. So they're paying less, they're paying more. And so
overall, it benefits you to have a bigger down payment and higher credit score on average and for the most part. So that has not changed.
yeah, exactly.
And this isn't going to, you know, another question we've got, is this going to lead to another financial crisis? Or people that don't qualify now can? Is, you know, are we lending out money to people that shouldn't be lent to? The short answer is no. Yeah. This is only on a conventional conforming loan. So this is not FHA, it's not VA, it's not jumbo, and it's only a 30-year fixed. And so if you're doing a 15-year on a conventional, which I'm a fan of, you know, shout out to Dave Ramsey, but right now this is only a 30-year fixed on a conventional. So it's not every borrower, but the 30-year fixed conventional is the most
Big
used
part of the
loan
market.
product in the industry.
Yeah. Okay. Well, that's it for that segment. Now we're going to jump into the cost of waiting.
Yeah.
All right. So take us through this first slide, Jordan. What are we talking about here?
Yeah, we're looking at a consumer that someone's looking to buy a house, and guys, what were we hearing last fall? Is rates were rising.
I don't want to buy.
Home prices were rising.
Yeah.
Should I wait? Why should I buy now? Should I wait until interest rates fall or prices fall? So.
Yeah. Or some people are just stubborn. I'm going to dig my heels in, and I am not buying until the market crashes, until home prices crash, until the market comes down. And what do we tell them was going to happen, right?
Right.
Especially in Houston, we can talk nationwide, but we've talked about how rates and, you know, there's the economy's nationwide, but real estate's so local, and especially in Houston, as Hughes showed us in other segments. In Houston, especially, home price acceleration has slowed down, but has it reversed?
No,
Absolutely
not really. I mean, and that's because of the inventory situation. So, you know, if you have a buyer who's sitting here and is like, maybe I should wait for rates to fall. Maybe they're at like the top of this sort of diagram, and maybe they are waiting for rates to fall, and they do, and rates do start to fall. But in a tight inventory situation,
And prices go up when rates go down.
right? Prices might go up. So you might move from a buyer's market to a seller's market. You could see if you move down this cycle in this diagram, and then you're sort of waiting for more for prices for homes to fall, and then again, as you wait for prices for homes to fall, rates might change on you. So getting caught in that vicious cycle is something that we see, you know, potentially buyers getting stuck in.
Yeah, we don't want our buyers to be a dog chasing their tail, right? It's hard to time the market. We've been trying to tell people, if it's the right house and you have the ability to secure that home for you and your family, do it. Right? The market's going to change. Rates will fluctuate. If you look at the historical data that we've seen, home price appreciation is very, very steady, right? With some blips in here and there, but rates are all over the map. And so looking at we'll look at the next slide here, but if you wait, especially in Houston, and this is a very, very modest growth here of $15,000 in home price appreciation. That same house, even if rates come down a whole percent, that same house is going to cost you more, right? So that's even if the Fed cuts and we see rates drop a whole percent, the same house, you know, in a stable market with low inventory, 2 months of inventory, right? we're going to still see borrowers spending more money for the same house.
Yeah.
And that's what we've been telling people the whole time is, right, the old saying that we've been saying since the fall, marry the home, date the rate.
Right.
And so we think there's a high likelihood you're going to have a chance to refinance in the next 12, 24 months. So the right house, it's going to be less expensive now to get it than it's going to be in 6 months, 12 months.
Yeah, I mean, you can see on the first table, you have a price of $500,000. You have an interest rate of 6.5% on a 30-year fixed mortgage. Your payment is going to be $3,730, and your closing costs are around $111,000. And then, like you said, you wait, and it's not even that much of an increase. 7%, $35,000 for that same property,
very
similar
likely
property.
in Houston,
Even if interest rates are a whole percent lower, let's say in 6 or 12 months. Your payment is roughly going to be the same, but you're actually paying around $7,000 more in cost. And that's if that house or a similar house of the same quality and features is available. And at least in Houston, inventory has been a really big situation. So, don't get stuck in that that vicious cycle. It could be costly to wait to buy.
Absolutely.
Yeah, I mean, the end of the story is that home buyers live by their monthly payment and whatever the money it costs to acquire that house. People get emotional about interest rates, but at the end of the day, it's can you afford the house? Is it the right time for you and your family? What's the monthly payment? What's the cash to close?
Yeah, 100%.
So don't wait. Buy now.
All right, now jumping into our last segment, just looking very quickly at some Houston area analysis.
H-Town.
Absolutely, this is something that we've showed before, but we like this slide a lot. And what this chart is basically showing, it's showing Houston area large employers, so employers that have a huge employment present in Houston that are publicly traded, right? And so they have stock prices, and so I put them on an index, and they're in the blue, and then I have the S&P index, the S&P 500 index in the red. And as you can see, the blue line is far above the red line, which is basically saying that Houston area large employers that are publicly traded are outperforming the wider market, which is a great signal for the future of Houston. Yeah. And it continues to be that case. And we've seen this, I first showed this slide back in November of last year, and it's remained that case. Yeah. And I think it's just a great portent for the future of Houston and for the business environment in Houston.
And that kind of reinforces the cost of waiting, right? Houston we've since the 80s we've become extremely with the second, third largest city. We're extremely diverse. Large companies employ a ton of people here, doing really well. A lot of people moving here. The biggest influx of people in the nation came to Houston last year out of anywhere else. All the U-Haul one-way data was to Houston.
Yeah, absolutely.
So for me, this just reinforces to our buyers and our realtors out there that this just reinforces the cost of waiting, right?
Yeah, absolutely.
Yeah, I mean the national economy can be contracting, but the local economy, Houston, can be expanding, and you want to see data to support that. Here you go.
100%.
So.
All right, so just ending in the summary with the summary real quick. So the first thing that we covered today was the U.S. labor market and the Fed's dilemma that they're facing. Yeah. There's a tight labor market that's keeping inflation high. But the good news is that we do expect rent prices to come down. We saw the CPI release today, and that was lower on a year-over-year basis than last month. It's continuing to be lower, at least that top line number. Shelter costs, we're expecting to come down, which should bring the core CPI down. So we're anticipating that in the later part of Q2 and going into Q3. We covered the loan level price adjustments.
Boo!
And we don't think that's not going to be a huge impact to the market, but we did want to go ahead and cover those. Yeah. And then, of course, we went through the cost of waiting. Should I wait now? Even if you see a small increase in prices, that could dramatically change the amount of money that you're spending to get into that house. And then, like we just said, Houston area large employers are outperforming the wider market, which is great for the future of Houston.
That's right.
So thanks for joining for this episode of Hugh Knows, and we'll catch you next time.
Adios, everybody.